Hello, everybody. How are you? All right. So last time we spoke about tax planning. We said how important it is to have a tax planner by your side to help you go over like your tax needs, your tax situation, and explain to you and suggest to you some tax strategies that are available out there to help you save on taxes. So we want to be more proactive about our tax situation. We don't want to be passive, just wait till year end to do tax planning or to file our tax returns. We want to be proactive. We want to go before we make a decision, before we do any tax decision, we need to consult. We need to know whether we're doing the right thing or not really. So today I want to talk to you about one single tax strategy that is way overlooked between taxpayers. They don't think it's really important, but I will show you why is it important. I want to help you understand the basics today of this tax strategy, and I want you to be able like to evaluate whether this is the right thing for you to do or not. What am I talking about? I'm talking about the tax like structure, the entity optimization, your structure for your entity. You have a small business. How are you structuring this small business? What kind of entity do you have? Is it the right entity or not? So let me share my screen with you here and we'll dig in. Oh, let me first do that. As you know, I always like to start with a joke. So, our joke today, do you know why they call it the um why it's not sharing? Do you know why they call it the IRS? Okay, we're sharing. Good. Do you know why they call it the IRS? Yes, because they keep their eye on you. All right. So, business entity optimization. What are we talking about here? I want to help you understand the basics. So first thing, just that from here. First thing, what kind of entity can I have? What are the entities? What are the business entities, the structures that are available out there? First thing you do is a sole prop, right? Or LLC, limited liability company. It usually starts like that. Limited liability company, LLC. And this, if we're talking about that you're single, we're talking about that you're one person having one entity. So you have a sole prop or you have an LLC, limited liability company. Limited liability company or LLC, you get taxed twice. You get income tax on your net income. So if you're having gross 100K, you have expenses of 20K, then you have 80K net income. You pay income tax on this 80K. You pay income tax on your net income from the LLC. In addition, you also pay self-employment taxes, which is about 15.3% on the net income. So the LLC, you pay two types of taxes. You pay income tax and you pay self-employment tax. Income tax is based on your tax bracket. It depends on your income from all sources of income that you have. So it depends on your tax bracket. You pay income tax and you pay self-employment tax, which is 15.3% on your net income. So this is one structure. Second structure is a C Corp, C corporation. C corporation, you pay income taxes on your net income, and currently it's capped at 21%. After the Tax Cuts and Jobs Act, it was capped at 21%. It was way higher before that. And now there are talks about whether it will be brought down to 20% or even 15%. We'll see what's going to happen about that. But currently, it's capped at 21% of your net income. But the problem is you get taxed, income tax again, when you take your profit out of the business, which is called dividend. That's why the C Corp is subject to what's called double taxation. Why it's double? Because number one, you get taxed on your net income when you're making a profit. And number two, when you take this profit out of the business, like you pay yourself, you get taxed what's called a dividend, or what's like you get the payment is called dividend, and you get taxed on this another income tax. So it's double taxation. All right. Then comes an S corporation. An S corporation, it could be an LLC. It starts as an LLC or C corporation. So S corporation is a tax structure. It's not a legal structure. You can go establish an S corporation. S corporation is an election. It's an S election. It's a tax election that you tell the IRS that I want my LLC or I want my C corporation to be taxed as an S corporation. And what's an S corporation? How do you get taxed as an S corporation? Number one, you get taxed on your net income. So same as with the LLC, same as with your C corporation, you get taxed on your net income. And you get taxed, self-employment tax, on what we call reasonable compensation. So you get you pay self-employment tax on you have to pay yourself reasonable compensation. You have to pay yourself some salary, and it has to be reasonable within the definition of the IRS, which put a lot of people, and we're not sure what is that reasonable. So it has some, you have to do some digging here and use some help to determine what could be a reasonable compensation. So you pay self-employment tax on this reasonable compensation. Can I just avoid not paying myself? No, you're not allowed to, because you have to pay some self-employment tax per the IRS rules. That's why it has to be reasonable compensation. But in this case, you won't be subject to double taxation like the C Corp. But depends on your income, you may find yourself paying more than the 21% that you're capped at. So you have to figure out from here which one really does make sense to you. Should you elect it as corporation or not really? Then last thing I want to talk to you about is a partnership. So obviously, it doesn't apply if you're 100% owner. So it could be a limited liability company. It could be like an LLC, but not a single member in this case. You would be a partnership. You would be an LLC, but with multiple people, like with more than one person. So it doesn't apply if you're 100% owner. And you get taxed, income tax on your net income, same with everything else. And you get taxed self-employment tax, which is the 15.3% on guaranteed payments if you're a limited partner. So if you're a limited partner, you provide service to the partnership, you get paid what's called guaranteed payments. And on this guaranteed payments, you pay 15.3% self-employment tax. Or if you are a general partner, then you pay self-employment tax on your net income in total, same as with the single member LLC. You know what I mean? All right, so from here, we see that we have multiple options, and you hear from a lot of videos and a lot of things. Oh, why S corporation is not the right structure for you, or why LLC is not the right structure for you, or why this, why that. And we get a lot of questions. Is this right for me or that? It can never be answered generally. It can never be answered generally. The answer is always, it depends. It depends on your goals. It depends on your vision. Are you expecting to have multiple members or not? Are you expecting to sell the business after a couple of years? Is this a short-term thing or this is a long-term thing? How much of profits you're expecting, how much income you're now making. Can maybe you start with a structure and then it change it down the road? A lot of things need to be evaluated here and assessed. When we look at a tax structure, we see your numbers. Going back to what we talked about last week, we have to assess where you are, like what's your past. We have to assess the current situation to see where you are now and if it makes sense. Why am I bringing this up now and why it's important to look at? Because with some like with the S corporation, for example, in order for you to elect an S corporation, you cannot just do it at any time of the year. You have 75 days from the beginning of the year. So you have to March 15 to elect an S Corp status if it determined that this is the right structure for you. But it might not be. So you have to consider from all these factors which one is going to be good for you. Don't just listen to one video that will tell you that this is the right structure for you, because it might not. Why? Again, it depends on your profit. Who told you that S corporation would be good for you if the C corp is capped at 21% or 20% if it goes down, or 15, who knows? Who tells you that it's gonna be good for you if you are not making much profit on the LLC, on a single member LLC, and you're not paying that much of self-employment tax? Who told you that S corporation is gonna be good for you if you have to pay yourself a salary and you don't know how much this reasonable compensation should be? So we get a lot of these questions about, okay, I don't know which one is right for me, and always the answer, it's case by case basis. If you need to like see whether this is the right structure for you, I encourage you to seek some help to assess whether this is really the right one for you or not. All right, this is it. Please let me know what you think about this presentation. Did you benefit from it? Do you have further questions? Do you think that you are at the right structure where you're at now, or you may need somebody to take a look at it and tell you you're not really at the right one? You have no idea. When I look at some tax returns and some structures, you could save thousands of dollars just by changing the structure that you're in. So don't, yeah, it drives me crazy when somebody tells me I already established a corporation and here we go, let's do taxes. I'm like, why did you do that? Like, how did you determine that this is right structure for you? Try to seek help before you do the action, because it may impact you. It may have like a great effect on how much you need to pay in taxes. So it's good for you to understand before you do the action, and to seek help before you do, to see what would be the right structure for you. All right, thank you, and see you next week. Bye.